Moving on to Nigeria, that market has been pulling back quite a lot this in the recent sessions, and yesterday was the same. We saw it come down about 0.7%. Let's now cross to Stanbic IBTC to get some thoughts on the banking sector, which of course is where there's a lot of interest, sustained interest over the years. Muyiwa Oni, a banking analyst with Stanbic IBTC, joins us for that discussion. Muyiwa, thank you for joining us today, and I want to start first of all by really focusing on your recent report on the sector. And I think two key takeaways for me there is that you still remain constructive, but you are downgrading some stocks at this stage on the back of the rally that we've seen recently. Talk us through the rationale for that.
Hi, Wole. Like you rightly highlighted, we've downgraded a couple of our recommendations on the banking sector, and it's really not driven, like you said, by a bearish outlook, but we're still very constructive, but it's more on the back of the strong rallies we've seen in this sector. So as at last quarter, the banking sector was trading at around 0.8 times price to book. Right now it's at 1.2 times, and the reality is that the earnings outlook hasn't changed. We still expect the sector to deliver ROEs of about 17% for 2012 and about 18% on average for 2013, which, if you compare it to banks like sectors like Ghana and Kenya, still looks attractive. But these markets are also delivering impressive ROEs of over 25%. And so what we did was we downgraded our recommendations of Diamond Bank to a hold from a buy. We downgraded Zenith to a hold from a buy as well. We downgraded First Bank, and we also downgrade, and we'd also downgraded UBA to a sell from our current hold recommendation. UBA is currently up about 75% year till date, and based on our earnings outlook, we see little scope for a, shall I say, steady increase in the stock at this point in time. And I'd say for the sector as a whole, we expect EPS to be up by around 17% in 2013 relative to the 79% growth we expect for 2012. So it's difficult to justify a steady increase in price based on what we've seen so far. The sector as a whole is up about 33% year till date, and so I would say what would really trigger a continuous increase in price right now is if we see an outperformance, not just for the 2012 results, but also for Q1 numbers as well. And the outlook on loan growth is still quite, should I say, modest in our view. In the report, we highlighted that right now, based on the current state of the economy, we expect loans to be up to grow by between 15 to 20% on average for the sector. A couple of names that we've spoken to expect loans to grow between 10 to 20. So we believe that it's economic reforms that would really push loan growth beyond that 20% mark. And based on that, it's difficult to justify steady increases, or shall I say rapid increases in share prices. And also, if you consider that the recoveries that we saw in 2012, it's difficult to expect that sharp improvement again in 2013. So that's another reason why we're...
Okay, very interesting points, very good summary there. But let's talk a bit about the potential for this market rather for the banking sector to trade at a premium, because we've seen that happen in other sectors like consumer names. We've seen some trading at very extended PEs of even about 30 for some companies. So many people will suggest that if you look at the liquidity in the market, liquidity globally, that this money still has to go somewhere, and the banking sector is perhaps still the best place for it to go. Your thoughts on that?
Yeah, sure, your point is right, and we also highlighted that in the report, because what we did was also to compare the discount at which the banking sector has traded relative to markets like Ghana, Egypt, and Kenya as well. And also, if you consider, I think what is really going to be important is investor sentiment on the market. So if forecast risk reduces as we continue to go forward, then the expectation is that investors will be willing to pay more. And so that's why even at this point in time, despite our downgrade, we still believe that quality still matters. So right now, within our coverage, we have buy ratings on stocks like FCMB, ETI, Access Bank. But the reality is that we still expect quality to prevail. So even though we have hold recommendations of stocks like GT, First Bank, Zenith, we believe that the premiums that they've traded at could continue as well. So that ties in with your views on liquidity and what we've seen the consumers do. So the reality is that for the investors, especially if you consider that the investor profile has changed as well, now we see more foreign investors driving the market, and that looks to continue over the medium term. And so the reality is that because they are far from the market as well, they would rather stick in the safe names and the very liquid names, which it's still easy to go in and out of, than the less, shall I say, less liquid names and the more risky tier twos.
Okay, Muyiwa, I have to wrap, but I want you to, in one word, give me the stock that you think is likely to surprise. I guess it's not a surprise if you can call it before the earnings season, but your thoughts on the company that may surprise the market in this earnings season.
Well, for 2012, I would say stocks you could look out for could be Zenith Bank and possibly Access Bank as well. Those two could surprise you.
I really have to wrap it up, but thank you so much, Muyiwa, for joining us on the show.